Here now with Corey Reed of John Deere. Corey, series of layoff announcements announced this week. We want to talk to kind of the things that John Deere's navigating right now. But first, let's talk about the newest news, announcing those series of layoffs, both factory and salaried employees. Let's first start off talking about the why. What is driving that decision by Deere?
Yeah, I think as you know and as your viewers know, the ag economy's come under some pressure. Obviously, farmer sentiment, they're pretty careful right now. The crops look decent out there overall if you go from one end of the country to the other, but net farm income is expected to be down in the mid to high 20s. And when that happens and commodity prices pull back and interest rates are a little bit higher and we see volatility in the weather and it creates uncertainty that creates some interruptions in demand. And we're experiencing that today. If you looked out across our industry, we're expecting the industry to be off roughly 20% year over year from last year.
Yeah, and in the Q1 earnings call, John Deere made clear, expected to be a 20% drop in some of this demand for equipment. It is in line with what you expected at the beginning of the year, or has it accelerated even more than what you initially expected?
Well, I think what we talked about there is still the case. We kind of had the tale of two ends of the year. If you looked at the front half of the year, in fact, if you took the large row crop tractor business, what you would have seen is a market that was still peaking in the April and May timeframe. A lot of buyers in the market based off of the performance last year. As we hit May and going into June, what you saw is those used inventory levels start to and continue to grow. And you saw buyers start to pull back. Those trade differentials look different for them, and they start pulling back at a faster rate. So, you know, the combination, that 20% is a front half of the year that looks pretty good, and a back half of the year where we're producing far fewer tractors and far fewer pieces of machinery overall in the second half of the year versus the first.
Well, speaking of that production, we know that prior to this week, you'd already cut a little over 1,800 jobs from plants across Iowa and Illinois, and I know that was a tough decision. This week, as you look some of those salaried positions that are being cut, how many and what type of jobs are we looking at here?
Well, look, first and foremost, those are the hardest days of any of our jobs, is to look out and look at a market that's pulling back, and understanding that we try as hard as we can to make sure that we build our own flexibility into our workforce. So the use of contract and contingent workers, we pull those back first. There are situations where the market turns fast enough that we can't do everything we have to do just by pulling back on those variable levers. And unfortunately, in some circumstances, we have to pull more of that and take full-time employees. We don't like to do it. It's something we don't do frequently, and it's something that weighs heavily on us. The thing I would tell you that we're proud of is when we do, you do it like you'd expect a John Deere brand. We know we have loyal customers. We know we have loyal employees. They show up every day. They work hard. They do their job in a way to drive value for our customers. And we feel like we want to treat them the right way when we have to say goodbye to them too. And it's something that's incredibly difficult. It weighs on both me personally and everyone in the company that has to make those decisions. But we're also proud of our brand and proud of how, even in the toughest circumstances, we show up both for our customers, but in particular in this case for our employees.
So when you look at, you know, there's been a lot of discussion about Deere moving some of the production to Mexico. How many jobs are we talking there? Do you want to address that? And what is the timeline?
Yeah, I think first and foremost it's important to understand that the movement of certain components or products to Mexico is entirely separate from what we've seen in terms of layoffs today. The layoffs that we're talking about today are based upon the market. We mentioned that farm profitability is down, demand is down. The back half, both in our agricultural lines of equipment and our construction lines of equipment, are not as strong as the front half. So when you see those layoffs, they're not tied directly to the movement of products. They're actually tied to the demand cycle and the order calendar that we have in place. So if you're building significantly less in the back half than you are in the front, you don't have the same requirements for workforce. And that's where the adjustments come from. That's first and foremost. Secondly, the movement, I can talk about the movement of some products or some components to Mexico. We've been in Mexico for nearly 70 years. 1956, it was one of the first operations outside of the U.S. together with our European operations we acquired. It's an important part of our global footprint. We've been producing tractors and components for almost that entire time there. We started in the tractor business. We put some component works. We're proud of that facility. It's an important part of our global footprint. And we move product around our global footprint all the time. In this case, the series of announcements were things like, and I'll use the example of our cab operations from our Waterloo factory. And that announcement was a couple of hundred jobs that moved out of Waterloo and moved to Mexico. And that's true. And it's part of our normal operation for how we look at where is the best place in our global network to be able to move equipment. Today we have 80,000 employees spread across 60 countries. We have in the US 30,000 employees, 16 different states, 60 operations, and we're constantly evaluating where is it that's best for us to move these products. So when we move a product, we make the announcement and say this portion of this product is going to move here. And by the way, we're doing that all the time. It's a part of what we do in our global network. What's not reported when we do that, and in the case of that particular line of product, the very product you saw down at Commodity Classic, the 830 horsepower four-wheel drive, if you drove to Waterloo today and went into the operations, what you'd see is that brand new tractor going down the very place in that factory where those cabs were manufactured before. So we talk about the movement of a component out. What the market didn't talk about was the movement in the investment. In this case, in the last 5 years in R&D and capital, we put nearly $1 billion into that facility. And if you walked into that facility today, you'd see probably the most modern assembly operation for the highest horsepower tractors in the industry. So look, we do move components around, and we move them to our global network to optimize where's the best place to build based on the skills and the capabilities, the availability of labor, all of the things that affect where we build things around the world, and then we invest behind it. In the case of that operation, we invest, and we have two new product lines, two entirely new product lines going into that space.
What is the timing of that?
Actually, the large 9RX tractors, limited production build just finished, and later this year we'll start into the full production build.
You mentioned Commodity Classic, and I go back to Commodity Classic. A lot of us excitement. I mean, rolling out the largest horsepower tractor ever. You know, but at the time we knew that commodity prices were eroding. We knew that inflation was an issue. We knew interest rates were high, but it seems like moods were still high then, and the outlook was still positive. So when you look at this downturn in the ag economy and the downturn in equipment demand, did that happen at a quicker pace than what Deere even expected?
Well, I think what you see is markets that are cycling faster today, and when you see what was going on in the commodity market, it's been more volatile here recently. So obviously, we'd like to have better predictability of those things. What I would tell you is the long-term outlook for global commodities that are grown here in the U.S. still looks really strong. And we're still bullish on that. It's the reason that even when we see these cycles potentially coming, we invest directly through them. We've never invested more in research dollars than we did this year, and we'll never invest more over the next 5 years than we have. This next 5 years we'll invest more than we have over the last 5 years. That's a testament to what we believe about the future of the agricultural industry, and we're doing that around the world. But the largest investments, back to the Mexico question, are right here. We've invested more than $2.5 billion in U.S. manufacturing and capital into those facilities in the last 4.5 years. That's multiple times anywhere else in the world. And we continue to grow both the jobs associated with them, although those jobs can flex up and down based upon what the total demand is in any given year. Our primary footprint throughout the world is right here in the U.S.
We talk about the fallout of $4 corn and some of the ripple effects and what we're going to see in the farm economy. But we've had $4 corn before. So what makes this down cycle in the ag economy? What makes it different, Corey?
Well, I think one of the things you see is that we were in unprecedented times over the last 3 years. So we were coming off the pandemic. You saw demand constructs, you saw supply interruptions, you saw people doing everything we could just to get product out the door. That was the entire industry. We were hiring people to help us get parts to the line on time. We were reworking product that were sitting on factory yards waiting for parts to come. We're trying to build up to get that demand coming, and people were experiencing record profitability on the farm. That created a move, a giant move in demand that the industry responded to. When things got more normal, when commodities started to pull back some, it created a larger break than people were used to. If you look year over year from 2023 to 24, it's the single largest reduction in net farm income that our producers have experienced in the last several decades. It comes off of all-time highs. So it is hard, and as we adjusted our operations, as our producers adjusted their operations, we continued to invest in the next generation of what we were going to do. When that pullback happens, it feels more severe. And if you look at what's going on in the industry today, we're reverting back to more normal levels. And each one of us across the industry, ourselves included, our customers included, are having to adjust their operations to what normal looks like in the future. I do think there are upsides. I think the global commodities markets, if you look at both the demand for food, for fuel, for fiber, And certainly on the renewable fuel side, there's tremendous opportunity for our industries long term. So we continue to invest to make our customers more profitable, more productive, more sustainable going into the future.
The adjustments that you're making this week in terms of cuts, was that proactive, or do you think that should have happened a few months ago?
Well, we started making adjustments even coming into this year. If you think about what we do on the inventory side, we understood where our industry was likely going to be. You mentioned we talked about it in the first quarter. We started pulling back on the production side earlier. Demand was still high, so we were producing at high levels, but we started planning towards lower ending both new inventories, and we started planning for what can we do to make sure that we can manage the used inventories that are out there. We went through a cost reduction effort across the organization to try to pull back on costs, putting more people towards the reduction of cost. I would tell you this, one of the great things about the technologies we're investing in with that R&D, whether you're investing to grow your yield or you're investing to manage cost at a different level, those technologies do the same thing. So think of See & Spray. See & Spray, we lowered the upfront cost. You pay for only what you use. It gets better every year. If you invest in that upfront cost, you can actually save on herbicide costs going into next year. And by the way, we lowered the front end of that to allow more customers to get into that cost-saving opportunity. It has to work in their operation. It has to be something that's meaningful for them. But to do that, we invest a significant amount of money. I mentioned $2.5 billion. One of the major projects we did was to build an all-new line in Des Moines Works to build See & Spray sprayers. And what you've seen is an industry where spraying has become, next to planting, one of the highest value things that customers do today. They have to get a great stand. The ExactEmerge planter is one of those planters that place the seed right, singulate it, get it to the right depth, get it into the right moisture, and you get a great stand. You get every plant coming out of the ground within 24 hours. It looks awesome, but then you have to protect it from what's out there. And sprayers have become the next highest value thing that we're doing. So we continue to invest through that, knowing that whether you buy that technology to grow the potential yield or you buy it to save cost, it's a great investment. What's interesting to me is we know that when farm income comes back, we have to manage through these cycles. So we try to understand what is it that we can do proactively to put ourselves and our customers in the best position going forward.
Are there certain segments of the equipment industry that are seeing demand deteriorate the quickest? I mean, you mentioned sprayers. I don't have any data on sprayers, but AEM, the latest flash report from June, showed combine sales down 31%, total farm tractor sales down 16%. That was just in June. That was just that month. So when you look at some of the, whether it be combines or high horsepower tractors or sprayers, how is demand holding up in each of those sectors?
Yeah, I think when you see farm income get hit like it has year over year from what's happening with commodities, and you have the prospect for a pretty good yield year this year, what ends up happening is carryover stocks put the future look at what might happen with commodities on hold. People are, what are my prices going to be like going into the next year? And people get pretty careful. We always see combine used inventories be the first thing that we look at. We proactively manage combine inventories ourselves. We went out into the market and said, we're not going to trade as many combines this year. We're going to work at holding back. We're going to give our dealers tools to be able to work through combines. Probably the next one in the industry is the used row crop tractor market. We watch very closely used row crop tractor inventories. As the market was peaking and more people were trading, the used was building. We pulled back proactively to try to not only reduce our ending new inventories, but to be able to allow the market to absorb more used machines throughout the end of the year. I think the good news, though, is if you look at the technologies that are impacting productivity, impacting yield, impacting the ability for a farmer to be more productive and more efficient, there's a need in the market for these products. It's how to get them efficiently into their hands. So let me use the example in the beginning, planting. What we've seen is a revolution in planting. The ability to move from 5-mile-an-hour planting to 10-mile-an-hour planting and do it even more accurately than in the past. And there's a lot of customers that aren't using that technology yet today. So those high horsepower row crop tractors, they used to be used for primary tillage work. Today they're used to pull high-speed planters. And high-speed planting is moving across the industry, and it's needed because the windows of time that we have in between weather cells, the things that happened this year when the crop looked like it was going to be late, and then in 10 days we planted the entire crop. That happens because of the technology that's out there. And when our customers can invest in the top end of the market, those folks buying those first new machines have done that. The units that are sitting out there in inventory today, they're needed in the industry. It's just a question of how we can efficiently move those into the hands of those customers that need that technology. And when they do, by the way, they see those benefits. They understand the benefit of that 7-day window of getting those crops all out of the ground at the same time, of being able to get that maximum yield potential and then protect it with the sprayer that needs to come behind it and spray only the herbicide needed. And in the future, that technology continues to evolve. So the hard news is that when those inventories grow, we pull back. We pull back proactively. In some cases, that affects how many people we have working in our factories. In the worst case scenario like this week, it affects how many people we have working on the salaried side of our workforce. We don't like that. That's not what we want to be able to do. At the same time, we are building the technology that's going to allow our customers to drive value in their farm each and every year. Talking
to some farmers, it seems like the cutbacks, they're just starting to cut back, and especially with equipment. So this year you're saying you expect a 20% reduction in demand. Any indication of 2025? Because it seems like right now farmers are more concerned about profitability in 2025 than they even are this year.
Yeah, I think it's early really still for 2025. If you look, we know we've got a good crop coming. What that means largely is that commodity prices will likely continue to be under pressure. At the same time, if you look at cash incomes and where people can be, there's still going to be some money in the market going into next year. We make commentary based upon some of the things we see in our early order programs. We mentioned in our last quarter that our sprayer programs were off to a good start. Look, what's happening in general is that you see the market reverting back to a more normalized environment. We look at the shape of those order calendars, and when we open up an early order program, 21, 22, and 23, they go vertical on day one. And it was because people were worried about, can I get a product, right? Today, people aren't worried about, can I get it? They're worried about what's the market going to look like and can I afford it? So what you see is an elongated decision cycle that's based upon, yeah, my crop looks pretty good. Interest rates, maybe they'll come down, maybe they won't. They look at, commodities, yeah, it looks pretty good right now. What can I get booked? Can I get my profitability booked? Input costs, what are my input costs going to be for next year? And the big part of what we have to do going forward is to allow customers to have more certainty about their cost structure, to understand when in the cycle they can understand how they build profitability into their crop for the next year. We're early today. It's certainly the case that if you looked at the back half of this year, the back half is light, but we're also under shipping in many cases a lot of the products versus demand. We're sitting around the world trying to bring those new inventories down so that as we look forward into 2025, we can build to demand, and in some cases if 26 looks good, we can build product going forward in greater than what the demand is within the year because we look for the cycle to come back. That's the planning cycle that we're in. It's early to say exactly what that looks like, and certainly around the world. We know today that the U.S. market is under some profitability pressure, but we remain with a bright outlook for the long term.
Are there any plans to cut the price of equipment considering the constraints that farmers are under?
Well, I'll tell you what we're doing. We're taking some of our latest technologies and we're cutting the upfront price of it. So if you take See & Spray as a great example, that product would cost hundreds of thousands of dollars to add to a machine. We lowered the upfront for a retrofit kit to be able to put it on for tens of thousands of dollars. So a customer that wants to manage their herbicide costs differently has the opportunity to buy into that on an acre by acre basis and only pay based on what they save. And it's an incredible opportunity for them to accelerate the opportunity to take the latest technology, put it on their farm, save money, and allow themselves to have a technology that gets better every year. We do the same with our technology products. So we have a product called Precision Ag Essentials, which is to get an updated position receiver display telematics device. We lower the upfront of that, and the back end sell on a service basis. And by the way, they only pay what they use. If they want a basic subscription, they can pay for that. If they want an advanced subscription, they can pay more, but it gives them the opportunity to put the latest technology, to invest in things that can both grow their yield but also save them money, and give them the option for how far do they want to go, but allow their fleet to be equipped with the core building blocks of what's happening in our industry, which is probably the most exciting thing. We talk about where we are in the cycle, and it's important, and it's important because profitability has to work at the farmer level. It has to work for our dealers, who are, by the way, the key to our success in every market. Our dealer organization is the John Deere brand to our customers day in and day out. We know that. So our customers have to be profitable, our dealers have to be profitable, and we have to sell products that are profitable. That's how it has to work. We're figuring out what is the model that allows that to happen most efficiently. None of us want a boom and bust cycle in this industry. We want to create consistent and increasing levels of profitability year over year.
You kind of answered this next question, but other than the workforce cuts, you mentioned the technology and reducing the price of that. What else is being done to address kind of the challenges that Deere is navigating right now?
Well, I would tell you this. I mean, over the last several weeks, just based on everything that's going on, I've talked to probably more dealers and customers in a 2 or 3 week period, just trying to understand their expectations from us. And first and foremost, they say, John Deere, it's really important you stick to the basics. It's give us quality product, make sure it runs when we want to, make sure it's fixable as fast as possible when it goes down, and make sure that we remain the focus of your business to drive profitability in each and every one of our farms. And I'll tell you, that's what we're doing. We're turning internally to manage our own cost structure. We don't like making workforce adjustments. We don't, but that's all about the cost structure we have so we can hold the line on cost. We're deploying more of our engineering resources to cost reduce each part without sacrificing any reliability, durability, or quality. We're doing that in a big way. We're trying to drive that quality throughout the organization and then make sure at the customer level we invest in both the people, the specialty, the infrastructure, and the dealer organization in a way that keeps them up and running the way they want to run.
Going back to the manufacturing cuts, 2.5 years ago when we saw the strikes, and then we did see that labor agreement come into place. We knew that there would be a cost for the increases in salaries. We had signing bonuses, we had all of these things that at the time, that was what was on the table and those negotiations had to happen. Are some of these cuts in the manufacturing side of your business, is it due to that agreement with the UAW? Well,
what I would tell you is certainly cost and availability and reliability of the labor in the workforce is a factor all the time. What we're seeing as cuts right now are not related to that. They're related to demand. The long-term manufacturing footprint, where we locate products, where we produce products over time, is certainly going to be related to the availability of workforce, the quality of the workforce. Look, here's the thing. We have the greatest workforce in the industry. Our folks that show up at the factory every day, you see, and the customers that come through our factories for Gold Key tours see the pride that's in their face and the work that they do, the quality that they build. We have an incredible workforce, but it's a struggle every day to build that next generation of workforce. You see us investing in automation. So what would have been manual welding every day, you see us putting automated weld cells in. Now, it still takes qualified welders. I met last week with 275 students that we're bringing in from high school at the age of 16 to teach them welding, to teach them electrical. So electricians, welders, machinists, and even IT folks that we start back in the high schools. The population in the places where we have factories is not growing like it is in metropolitan areas like here. We have to be able to build a great workforce. It has to be reliable. It has to be affordable. And we move products around, and that's based on strategically what's our footprint look like. But there's nowhere in the world we're more committed to manufacturing than right here. We have 13,000 wage workforce employees, and that number has grown up and through 2019. It grew even further as we were hiring people to do things like chase parts and rework equipment and put ourselves in the position to be able to get product out on time to our customers. As the schedules come back, that number grew above, and we're still at or above that number from 2019 and 2020 today. So we're nowhere in the world are we investing more than right here in the U.S. We're proud of that workforce. We rely on them every day. And I would tell you, you walk through those factories and see the folks putting the product together. There's no one in the world better at it than the workforce at John Deere. So look, we want that footprint to be successful. We want our workforce to be successful, and we invest in it every day.
Just a couple questions left.
Okay.
One, do you think we're on the brink of an ag recession? I mean, that is the concern right now from economists. It's a concern from farmers too. Does Deere feel like we are on the brink of one?
Well, I mentioned before, we see the long term, and this is the thing in our industry that's very difficult. Every one of us can have a view of what we think the long term. We're not very good at the short term. We're not very good at predicting those inflection points. We're not very good at responding quickly when those inflection points occur. here's what I would tell you. We're never more than one weather event in some place in the world away from commodity prices that spike. And if you look at what happened in the last 10 years, a lot of the spikes that happened from a drought here or a drought there. In the South American market this year, you could see it. We had a 20% hit to the soybean crop in the Mato Grosso region from a drought that happened. We saw a price spike that occurred at that point. You have a flood in the south. You see that happening. It's the same here. We're never more than one weather event away from a commodity price spike. At the same time, the most important thing we can do is to build cost resiliency into our business. Put ourselves in the position to be able to grow more, to be able to do it with less. The world outside of every individual farmer is going to work on the demand construct. We can't predict what's going to happen tomorrow with biofuels. There are a lot of people talking about that. Look, there are a lot of reasons it makes sense, and you hope that it's not a political statement. You look at what our producers do. One of the most reliable, one of the most cost-effective, and ultimately one of the most sustainable things we could do is grow biofuels use throughout the country and around the world. You see it happening in many places around the world, and I think the long term for that, people will look at it and say, yeah, that's what's going to happen. So we remain long on what's going to happen there. We support our producers to do it. So look, in any given year, you can see income go up or go down. If you look at the indicators of where we think interest rates are going to go, that should start coming back. If you see inflation, it's starting to come back to us. The long term looks good. It's the short term turbulent years that are incredibly difficult to predict. So it makes sense that customers are being careful today. It makes sense that they're delaying purchasing decisions until they understand if they can book their profitability. We understand that, and we're doing the same thing.
Speaking of that turbulence, as farmers do stare at commodity prices right now, sometimes below the cost of production, that's the reality. What do you want farmers to know right now?
Well, look, here's the thing. We have 80,000 employees in the company. Our 80,000 employees wake up every day with the same purpose. That purpose is quality, innovation, integrity, and commitment to our customers. We want to grow value on each and every one of those farms. We want to do it in a way that every day they wake up, every pass they make through the field, they have confidence that they're partnered with someone in the industry, John Deere and our John Deere dealers, that are working to drive value, working to drive profitability on each and every one of their farms.
Okay. Thank you. Appreciate it.